Hi, it's March 23rd, third day of spring 2020. We're all on coronavirus lockdown. I hope you're doing okay and do stay safe. This is going to be a short online lecture focusing on the costs of inflation, and it's really just an introduction to the blog post and supplementary reading, The Costs of Inflation. And so I mainly just want to take you through some of these main headings and talk about them. So I wrote this blog post because I thought the emphasis wasn't right in the discussions of the costs of inflation. Because to me, the two big ones are messing with the price system and messing with our minds. So let's talk about that. So here's number one, messing with the price system. So one analogy that I like a lot is of a free market system to a computer. So we're trying to compute ways of getting people what they need and having the right people produce the right things. And that's a very complicated process. And the prices are really a key part of the circuitry. If you mess up the price system, now it's like the literal bugs in the computer. You may not realize it, but software bug now means just a part of the code that's written that doesn't work very well. But there was a time when in some early computers, they had actual literal insects that would get into the circuitry and cause trouble. And inflation does something like that. It just messes up the price systems. If a price is too low, people will go buy too much of that. If a price is too high, people will buy too little of it. So you have the wrong mix of things, and people aren't, if they're not getting the things that they really want, given how costly it is to produce them for society, then there's some real inefficiency there of not having the thing you really want or the thing that would be the most productive. So that's messing with the price system. You're just making the free market system stupider, and the wrong things are getting produced and they're getting distributed to the wrong people. Okay, now let's talk about messing with our minds. So inflation is just plain confusing. If you even if you've taken a couple of macroeconomics classes, some of the issues can be quite complicated. Let me give you a few examples of where this might be an issue. So suppose we have 2% inflation and somebody doesn't understand inflation. They might think the rate of return they're getting and saving for retirement is higher than it really is. And if they go see a financial planner, maybe the financial planner knows to correct for inflation, but financial planners don't come free, and so that's an issue. Now, one of the ways of demonstrating that inflation messes with people's minds is it messes with the minds of legislators. There are a lot of provisions, particularly in the tax law, that just don't make sense given inflation. And if you just can't look through the tax law and how it handles inflation or doesn't handle inflation and think that that's all perfectly rational. Now, it might well be that higher inflation makes some provisions of the tax law more like you'd like them to be, or that lower inflation makes it more like you'd like it to be. But I want to claim that having zero inflation is likely to make the tax law be more nearly what it was intended to be. And you know, it's not just the tax law, it's other things like minimum wages are not routinely adjusted for inflation. It's hard to, Social Security is adjusted for inflation, but it's hard to do it perfectly. So anyway, there are a lot of issues with messing with our minds, of which this is really a subtype. Then a fourth issue is that inflation messes with debt contracts. And this is particularly true if the inflation is a bit of a surprise, and particularly true if the debt contracts are very large. Now, this can go in various directions, but the great inflation of the 1970s meant people who had bought mortgages before inflation went way up, and they were 30-year mortgages. Now the inflation meant that the value of their house was going up, but their mortgage payments were not, if it was on a 30-year fixed loan. And so some of the folks in my parents' generation, more like your grandparents' generation. I'm an old man, I'm 59 and a half now, but in your grandparents' generation, some of them made out like bandits because their houses went up in value along with inflation and along with other forces too, but right now we're talking about inflation, while what they had to pay on their mortgages didn't go up. But if you think of that situation, there's always the other side to the transaction. The banks that held these mortgages as assets now weren't getting mortgage payments that stacked up to the consumer price index as well. Okay, so at any rate, things are not what people thought they would. Some people are benefited, some people are harmed, but it's not the way people thought it would be. The fifth thing I'd mention is messing with the opportunity cost of money. Now, in my view, messing with the opportunity cost of money is way overemphasized in the discussions of the costs of inflation. It can obviously and if it's hyperinflation, all kinds of things are big, and this too would be a big deal. But with modest levels of inflation, how big a deal is this really? First of all, it's not even really about inflation. Suppose you thought that people were holding too little paper currency because it earned less than treasury bills. Well, that's really about the gap between how much people earn on paper currency and how much they earn on treasury bills. It's a tradition that people earn a zero nominal return on paper currency, but that's not some law of nature. We could vary that. And you need to do deep negative interest rate policy. So I've thought about it for that reason. You could imagine having a rate of return on paper currency above zero if you needed to. So this is really not strictly speaking a cost of inflation. However, as long as you do have a tradition that you're holding to of having a zero nominal rate of return on paper currency, then a higher rate of inflation will get you a higher treasury bill rate, let's say, and therefore a bigger gap between the treasury bill rate and the rate of return on paper currency. Notice that the nominal return on treasury bills includes the real interest rate too. So honestly, the opportunity cost of money, even in that case, isn't just inflation. It's inflation plus the real interest rate. So for a lot of reasons, this isn't the thing I would emphasize. There's finally one other thing is there are some benefits to having having a real opportunity cost of holding paper currency, namely that people use paper currency a lot for avoiding taxes, trading drugs that can be damaging to people. And it's not, once you include the societal costs of avoiding taxes and other illegal activities, it's less clear that there's a big social harm from people underusing paper currency. Now, I do have to say that given the way banks don't raise the interest rates on checking and savings accounts very much when say the interest rate on Treasury bill is higher, it is true that higher inflation tends to make people want to shift out of checking accounts and savings accounts, and that has to do with some features of some degree of lack of good competition in attracting bank deposits. I think because it's a pain to switch from one bank to another. So there are some other things that aren't just about the demand for paper currency. Okay, so those are many of the costs of inflation. There are a few more things I want to mention. One is, inflation messing with our minds can just make us make bad decisions at a personal level, but it also might make us make bad decisions about how much we're willing to pay to fight inflation. People get confused, I believe, in the following way. If you think of the real wage as the real wage is here let me spell this out. Making us blame inflation for things it didn't do. So this is a weird cost of inflation, but if inflation makes us blame it for things it didn't do, it could be that a big part of the cost of inflation are the costs we undertake to fight inflation. So think of the real wage there. People might get confused and think they're getting raises in their nominal wage because they're such great workers, and then inflation is just stealing that away and giving them a lower real wage. Now, that's not the way the economic models work. The economic models say this real wage is equal to the real marginal cost product of labor, which in turn is determined by the technological situation. Remember, and the quantities of capital labor. Remember the model of Chapter 3. And so we'd all like our real wages to go up more, and it's sad that they don't, but it's not inflation, it's not the increase in the price level there that did it. It was a matter of technology and the amounts of capital and labor. You can do a similar thing in talking about the real interest rate. For people saving for retirement, like me, a higher real interest rate makes it a lot easier to save for retirement. And people might blame inflation for dragging down the real interest rate, but in fact, this real interest rate is determined by long-run forces that we talked about in Chapter 3, and so inflation doesn't lower it. It's also true that in the long run, the Fed doesn't determine this either. So it's, I worry for my own saving for retirement. I don't have too many worries, but my biggest single worry is that the real interest rate and real interest rates of return more generally, that is kind of the counterpart of the real interest rate for stocks and other risky assets too, that will be low. But I don't think I would blame inflation for that. Now, there is one interesting way that inflation can mess with people's minds that many economists count as a benefit of inflation. Making real wage cuts go down more easily. So if people are blaming inflation for dragging down their real wage, then the company, by just having, say, a wage freeze, or having, say, just a 1% increase in wages overall, they might get away with it because people blame inflation for their real wage going down instead of the company for making the real wages go down. But now, on the one hand, having the real wages be able to go down more easily could sound like a bad thing, but most economists count this as a benefit of inflation because it reduces social conflict. And if the real wage is being determined reasonably by the marginal product of labor, there's some strong forces going in that direction, and there'd be some inefficiency and some messing with the price system if the wages were higher than that. And in terms of getting, if the firms had to reduce wages directly, you'd have more social conflict, and social conflict is not a good thing. And, to make an understatement, social conflict is often quite inefficient. Now, hyperinflation is going to mess with all of these things a lot. Now, so think of amping these things up a lot. The last thing I want to say is that I do take these costs of inflation seriously, and this messing with our minds is something that's understated by many economists because it's actually not easy to model. We don't have good economic models for messing with our minds that are easy to use, and so many economists underestimate the extent to which inflation causes trouble by messing with our minds. So if you set this opportunity cost of money to the side by saying, look, we can choose what the paper currency rate of return is, then all of these others are going to be, all of these four here, which are the big ones, are going to be or especially these three, are going to be the least if you have zero inflation. And so zero inflation is nice. The big trouble with zero inflation is if you're holding to a tradition of a zero nominal interest rate on paper currency, or even worse, thinking that it's a big break with tradition to have a negative interest on reserves, then then you're putting a limit on how low your real interest rate can go and how much you can stimulate your economy. In particular, if you think of this formula right here, real interest rate equals nominal interest rate minus inflation. If you limit yourself to only going down to a zero nominal interest rate, then you can't get inflation lower than minus inflation. So if we have an inflation target of 2%, you could stimulate the economy to the extent of a minus 2% real interest rate, but you can't go any further. If you have inflation at zero and you have this bad tradition of not having negative interest rates, then you can only take the real interest rate down to zero, and so that's not as much stimulus. So most central banks now are reluctant enough to use deep negative interest rates, like pretty much the lowest anyone's gone is about minus 0.75%. As long as there's some limit on how low they're willing to go on the nominal interest rate, then they feel they have to have some inflation to make that limit be a lower real interest rate. But as soon as you take away any limitation on the nominal interest rate, now you don't need the inflation for that reason anymore. And these reasons would mean we'd want to have inflation close to zero, unless we're very worried about making real wage cuts go down easily. So anyway, that's a bit about the costs of inflation. There's quite a bit more detail in the blog post, The Costs of Inflation, which I'll leave the link for. Thanks for listening. Bye.